Welcome to the Explainer. If you look at the biggest brands you interact with every single day, the ones making your phone, your car, your morning coffee, or even managing your bank account, have you ever stopped and asked yourself who actually owns them? It's a pretty fascinating question, right? We usually picture these visionary billionaire founders running the show, or maybe we imagine millions of individual everyday day traders just frantically buying and selling stocks to shape the market. But the reality, the actual truth of modern corporate ownership is far more concentrated, deeply hidden beneath the surface, and frankly, a lot more fascinating than you might think. 40%. Yeah, according to comprehensive data analysis, just 3 asset management companies are the single largest shareholder in over 40% of all publicly listed U.S. companies. That is a level of concentrated corporate ownership that's literally unprecedented in modern capitalism. So how in the world do we get here? Well, let's break down how we got here by contrasting the 2 main ways people invest. First, you've got traditional active management. These are your classic high-fee stock pickers trying to beat the market by trading frequently. But on the flip side, we have passive index funds. Now, these funds don't even try to pick winners. They simply buy a little bit of everything to replicate an existing market index, like the S&P 500, and they just permanently hold those shares for ultra-low fees. Eventually, investors woke up to a pretty stark reality. Active managers rarely actually beat those benchmark indices over the long haul. I mean, why pay high fees for lower performance? And that realization sparked this historically massive migration of wealth. Between 2008 and 2015, investors dumped $800 billion from active mutual funds and poured a staggering $1 trillion straight into passive ones. That pushed the passive equity fund industry completely past the $4 trillion mark by 2015. Section 2. Meet the Big Three. Because when $1 trillion moves across the financial system, someone's got to be there to catch it. And look at this breakdown. We are talking about an absolute oligopoly here. BlackRock, Vanguard, and State Street captured the overwhelming majority of those massive passive wealth inflows. Together, they now control over 70% of the entire exchange-traded fund or ETF market. Everyone else is just left fighting over the scraps. $22 trillion. As of 2024, that's the estimated combined assets under management for just these 3 firms. To put that completely staggering figure into perspective, $22 trillion actually rivals the entire GDP of the United States. It's a scale of wealth that fundamentally reshapes how global markets work. So what exactly does $22 trillion buy you? Well, it makes you the loudest voice in the room, by far. Together, the Big Three make up the largest single shareholder in roughly 88% of all S&P 500 firms. In nearly 9 out of 10 of the most important corporations shaping your everyday life, these 3 firms are the top owners. Which brings us to this really fascinating paradox. The funds they sell to you and me? They're completely passive. They just blindly buy and track an index. But the firms themselves, BlackRock, Vanguard, State Street, are incredibly active owners. They hold the voting rights for all those aggregated shares, and let me tell you, they do not sit on the sidelines. So how does this hidden power actually work? Well, they use centralized proxy voting teams. Basically, they're casting votes on crucial company decisions on behalf of all their investors, us, the actual owners of the money. But they don't let their individual fund managers vote randomly in different directions. Instead, a giant like Vanguard or BlackRock speaks with a single, unified voice across all their thousands of disparate funds, which maximizes their leverage through sheer, coordinated size. Now, to be fair to the data, they actually side with corporate management's recommendations over 90% of the time. But, and here's the catch, when they aren't happy, they can't just sell the stock. Remember, as passive indexers, they're locked in. So instead, they specifically leverage their massive voting blocks to oppose director re-elections. Or they lean in on environmental, social, and governance, or ESG proposals, to really make their stance known. But honestly, the real influence often doesn't even show up on a public proxy ballot. It happens behind closed doors. Just look at these numbers. In a single year, BlackRock held over 1,500 private engagements with corporate management, and Vanguard held over 800. And corporate executives absolutely have to listen during these private meetings, because the Big Three are permanent, non-exiting block holders. They literally aren't going anywhere. Okay, so this leads us to a major systemic risk that academics are really waving red flags about. It's called horizontal shareholding. Because the Big Three buy the entire market index, they end up owning significant chunks of all the competing companies within a single industry at the exact same time. Think about it like this. If you own a massive stake in literally every major airline, you have very little incentive to encourage them to fiercely cut ticket prices to steal market share from each other. You just want the whole sector to remain comfortably, maybe even uncomfortably profitable. And researchers are actually starting to quantify the hidden social costs of this. Academic studies suggest that this common ownership inadvertently bumps up prices for everyday consumers. For example, in the highly concentrated U.S. airline industry, this phenomenon has been linked to a 3 to 11% increase in ticket prices. We're seeing similar anti-competitive effects, like higher client fees, in the banking sector too. What's truly wild to think about is that the 401ks we all use to save for retirement are often the exact investment vehicles quietly feeding this very system. And, it's absolutely crucial to realize this isn't just about airlines or banks. This universal influence spans the entire global economy. Their immense portfolios give them structural power over virtually every sector. We're talking military hardware and defense contractors like Lockheed Martin and Raytheon, the major media networks shaping our public narrative like Comcast and Disney, even the tech and consumer goods giants dictating our digital lives like Apple, Amazon, and Google. They're universally invested in all of it. Which brings us to our final section, the Giant 3 Spectre. Let's look at a very real projection of where corporate governance is heading in the near future. We're pulling this directly from a really prominent academic working paper by researchers Bebchuk and Hurst, literally titled The Spectre of the Giant 3. Their exhaustive data analysis comes with a stark warning. If current growth trends hold, the big three are rapidly morphing into something even larger and far more dominant. Just look at this timeline. It's staggering. Back in 2018, the big three already cast about a quarter of all votes at S&P 500 companies. But here's the kicker. Because they religiously vote all their shares, while everyday retail investors often ignore their proxy ballots entirely, their proportionate voting power is accelerating fast. In the next decade, they're projected to cast 34% of all votes. And in just 2 decades, they could cast over 41% of all votes in corporate America. And as their power grows, this total corporate behavior actually starts shifting on a psychological level. Because the Giant 3 are so structurally prominent, CEOs are proactively internalizing the asset manager's goals before a vote is even cast or a private meeting is even held. Management simply presents itself as already wanting exactly what the giant index funds want. So, let's wrap up with one really provocative question. Almost a century ago, the defining feature of the modern corporation was established as the separation of ownership and control, meaning millions of dispersed owners leaving the actual control to dedicated managers. But with just 3 massive firms soon holding nearly half the voting keys to the entire economy, have we quietly, accidentally unraveled the fundamental structure of modern corporate governance? It's a staggering thought and definitely something we all need to be watching. Thanks for joining me on The Explainer.